Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, today's video is the part 2 to why Adobe is impossible to disrupt, where in part 1, I essentially just covered the AI risks of the business and why they're massively overblown. AI, just like many other companies, is likely going to be yet another secular tailwind and another growth vector for a business like Adobe that has massive amounts of distribution. And I essentially laid out my case as to how AI will actually end up helping out Adobe as opposed to being a disruption threat. Today's video is the part 2 to that. And these two were recorded back to back. In part 2, I kind of covered the seat dilution issue, which essentially just refers to, okay, sure, AI doesn't disrupt Adobe, but what about a scenario in the future where AI makes each employee so much more efficient to the point where there's less licenses total? A company today that pays for 100 licenses of Adobe, maybe in the future they only need 70 or 60 or 50 or just less total. Doesn't that still kind of spell bad news for Adobe? And we kind of cover why that also doesn't really make too much sense. And then additionally, of course, I also cover the competition issue, because a lot of people seem to think that not only are they under threat by AI, not only are they under threat by the seat dilution issue, but also there's a large amount of competitors for Adobe. There's Canva and Figma. There's DaVinci Resolve. Affinity just went free, etc., etc. And again, we kind of tackle that issue as well, more so through the lens of who is Adobe's customer and trying to get an understanding of that. And again, I don't mean to spoil the video for you, but ultimately why that doesn't really impact Adobe too much. So I hope you enjoy part 2 of the video. But before we jump into that, I'd like to bring your attention to 2 things. Number 1, I'm feeding the homeless with your money, ideally. So basically all of the signups and all the money that I'll be making from the Patreon or the Discord, by Christmas Day, I'm going to allocate all that money towards either feeding the homeless, or I'm going to be calling up a local homeless shelter and seeing what they need and providing that to them. So far, we've had a massive amount of people signing up. A lot of people are sending me more than the $3 a month. Somebody even sent me $50 to do this. So it's been, so far, a very successful cause. Link for that is in the description. And it's not like you're just making an empty donation. You do get Discord access. There's, I think, 25 exclusive videos in here, 26 now. And obviously, you know, I post at least once a week on here as well. There's a whole bunch of discussion boards with a whole variety of different stocks and community members contributing their research into here. We have 330-ish members now, so there's a very active community that we've built up here as well. And your $3 ends up going to feeding the homeless, so it's a good thing overall. Another thing, video is sponsored by Fiscal AI, and they're doing a Black Friday sale. And this is one of your only chances to get this research tool at a discount. You've seen me use it over the past 2 years religiously. I always pitch it as this is essentially a form of education for you, where you become a better investor as a result of being able to make these charts, understand the numbers that drive stock returns, be more well-versed on the fundamentals of these businesses. You'll see me use it throughout the deep dive today as well. And right now you can sign up for Fiscal at a massive 30% discount on all paid plans. Link for that is in the description as well. There's also a 2-week free trial in there. So the sale is running for about another week. Feel free to sign up for the completely free, no card required free trial. Test it out a little bit yourself. You'll start to see the value that this research tool brings to me and hundreds of thousands of subscribers already. Again, proof is in the pudding. The software is genuinely incredible, and it's the only sponsorship that I've ever taken on the channel. There's a very good reason for that. There's genuine ROI for you, the investor, and it's a tool that I can wholeheartedly say has made me a better investor. 30% off, limited time Black Friday sale. They only do a few sales, usually only just a Black Friday sale every single year. So this is essentially your only chance to try to get this research tool at a discount. I highly recommend at least you check out the free trial and kind of see how you're feeling after that. With that being said, enjoy the deep dive. Welcome back to part 2 of why Adobe can't be disrupted. In part 1, I'm assuming you watched it, we talked about how AI is essentially a non-factor when it comes down to disrupting Adobe. In fact, we have a great deal of evidence to support the fact that AI will actually long-term benefit Adobe, if anything. And all of the companies that make the AI LLMs are actually currently partnered up with Adobe, and that kind of speaks for itself. Here in part 2, we're going to be talking about 2 different things, well, 3 technically. But first and foremost, I want to cover another sort of point of sort of bearish sentiment with Adobe, and that is the increased competition from cheaper, more nimble, better tools that can kind of do what Adobe does, but cheaper, better, whatever the case is. The ones that kind of come to mind is Canva and Figma that you often get thrown around. So we'll talk about competition. We really don't need to spend much time on those, but anyways, we're going to. And then additionally, the productivity gain will be dilutive. That means that, there's going to be so much productivity unlock from the AI that Adobe that charges per license or charges per seat, you need less employees to do the same amount of work. So Adobe is going to, be a net negative, all things considered, even if they don't get disrupted by AI. And so we'll kind of talk about that and how they're pivoting the business to kind of position themselves that if that is the future, again, also benefit from it. So we'll kind of cover all that. But first and foremost, the competition. Oh, and valuation work at the end of the video. So everything's timestamped. Feel free to skip around. But yeah, in terms of competition, you Google this is the first thing that came up when I Googled it, right? Who are Adobe's competitor? And this is 5 years old, but point still stands. If we're talking about competition, the landscape hasn't really changed. I mean, we've seen the rise of Figma and that's about it. But who are Adobe's competitor? Theoretically, yes, but practically no. Adobe has a virtual monopoly on the graphic industry through new programs that have come out to challenge them now and again. There are several I rather like now. The Affinity programs, for instance, and I checked them out. Practically speaking, I'm not running to switch. Adobe is cheap enough now that I'm comfortable using it. Everybody I know uses it. All the people I've ever done work for like it. It just doesn't make my sense to switch right now. And I can read you an excerpt from the Morningstar report, but I'm going to roughly sort of paraphrase it. But they essentially said in an industry that is mostly standardized around the software, it's very difficult to switch off of the software. Again, 60% revenue market share of the industry, 90% of the professionals in the world use the software. It's a virtual monopoly. It's not an outright monopoly. It's a virtual monopoly on the software. There's very few instances of people using different things. And in those few instances, for example, Figma, it's not really a direct competitor to Adobe anyways. You can Google this, but Figma and Photoshop do not compete directly. Figma is mostly like a collaborative UI UX sort of tool, which is used for, like websites and logos and stuff like that. Yes, you can do that inside of Adobe. That's not what Adobe is primarily used for or what it's made for. The direct competitor that Adobe had for Figma was Adobe XD, but they shut that down because they anticipated that they would end up buying Figma. By the time that deal fell through, they ended up realizing they're way too far behind to kind of reignite that project, and so they just gave up. They just gave that niche away to Figma. Figma is actually effectively a virtual monopoly on UI UX design. It's very, very popular. I don't need to tell you that, right? But that's it. That's the only thing that Figma does. It doesn't really do anything else. They tried making these like draw tools and stuff like that to try to compete with Photoshop. It's garbage. It doesn't work well. I'm sure within, the very distant future, they can kind of iterate on that. But over time, it's still very difficult. Even if you get a better software, it's very difficult to try to upend the Adobe suite of products. Even if you make something better than Photoshop at a more affordable price, the point is it's not just Photoshop that you're buying, it's the entire bundle. The example that, shout out to Alonzo, by the way, who gave this idea to me, but you can kind of think of it as the Microsoft Office suite. You can make Notion, for example. Notion is a note-taking app, right? Notion is objectively way better than Word. Why do the majority of the world still use Microsoft Word to type their letters and emails and whatever, their essays, whatever the case is? Why does the world use it? Because it's kind of standardized around the world to use Microsoft Word. And in fact, that's how I kind of would describe it is Adobe is ultimately the Microsoft Office suite of the creative world. The world has standardized around it. Even though there are free competitors that are in some cases better, why do people still end up paying for it? Because it's the standard. It's pretty straightforward. You know what I mean? And so just to kind of hammer this point in, I'd like to show you a clip from Linus Tech Tips, of all people, where 5 years ago, so again, it is 5 years ago, Figma is a little bit newer, whatever the case is, point still stands. 5 years ago, he made this video, why do I pay Adobe $10,000 a year? And essentially what he tried to do is make this video that we're watching without any Adobe products, and here is the conclusion that he came to by the end of it.
So that's it, we did it. We edited a video, start to finish, without Adobe. But are we gonna keep this liberation train going and swear off them for good? No, we're actually going to crawl straight back to them, and here's why. First up, the size of their app library is unparalleled. Whether you're creating videos with effects, audio, image, documents, web pages, there's an app for that. And in today's age where many creators are one-man or woman bands, instead of having a DIT for ingesting, an assistant editor for logging, an editor for cutting, a designer, an animator for graphics, and so on and so on and so on, a single ecosystem is very attractive, even if its bugs occasionally make the biblical plague of locusts look like not that big of a deal. Second up is intercompatibility. For better or for worse, pretty much everybody else uses Adobe. And nobody likes to be that guy who sends the weird file formats that nobody else can open. The thing is, you don't get to pick who you're doing business with, and not everybody out there in the great wider world has the tech savvy or the willingness to deal with your snowflake file format. And guys, it's a creative industry. Collaboration is a big part of it. Finally, I realize it's been mentioned a couple times already, but the way that Adobe's apps dynamically link with each other drastically cuts down on the time that you would otherwise spend saving, exporting, editing, and then importing files between your apps. So I asked our team how close they think we could get to Creative Suite levels of efficiency, and the highest number that I got back was as much as 90%. On the face of it, that sounds pretty good. That's an A. But let's do some napkin math here. The average video editor in the United States makes about $29 an hour. We've got 7 of those. So assuming that we were paying those rates, our editing staff would cost us about $420,000 a year. Oh, nice. So then if we were to slash their productivity by 10% by taking away their preferred software as a cost-saving measure, we would need to either cut our 17 video per week production schedule, costing the company revenue, or we would need to hire to cover that difference, costing the company over $40,000 a year, plus the extra space we need in the building, extra editing workstation. I think you see where I'm going with this. I mean, we're not saying that using Vegas or Resolve or even some of the awesome free editing tools out there, like HitFilm Express, aren't going to work for you. We're just saying that even if it does feel a little bit like Stockholm Syndrome, Adobe continues to be our best option.
Did you see what just happened there? The highest number he got was 90%. So at the end of the day, you hear all these people complain about, oh, Adobe is too expensive and this and that, and they keep raising prices, whatever. They keep raising prices because the value that they're providing significantly outweighs the cost of the software and the cost increases with the software. So even though they were able to make this video for 5 times less than what it normally would, that's ultimately irrelevant because of the productivity loss if you were to move forward. One thing he didn't even mention is all the relearning time costs that are incorporated with this. If you force to switch all of your employees over, and this is only 7 employees, if you force to switch all of your employees over to a different software, do you know how long it would take for them to relearn it? Probably up to a year. What is the cost, right? For a company in this case, he's making 17 videos, was it a week or a month, right? Whatever. The productivity loss on making those videos, what is that worth? And it costs company revenue. Not to mention, if you switch over, you're probably going to have to hire more editors, which costs even more. So ultimately, you're better off to just leave it how it is. It's a well-oiled machine. Not to mention, you have to work with other people with the industry. And as he mentioned, nobody knows your snowflake file format, right? So it's like a network effect built on top of switching costs, built on top of there's a huge value capture and a huge consumer surplus through the price increases that Adobe can recognize over time. I mean, the moat is massive here. Not to mention the bundle of software. So that's another point he brought up that I completely forgot. The bundle of software. All the softwares work really well with each other. This is the ecosystem moat of Apple brought into Adobe, which, by the way, that's a fascinating history in of itself, how closely tied the rise of Adobe is with Apple. Actually, part of the reason we have Adobe today is because I think the very first deal that they ever got was because of Apple. So anyways, that's a topic for another video, but the ecosystem of Apple exists with Adobe as well. All the apps work really well with each other, but not well with other apps. When you make something in Photoshop and want to, polish it up in Illustrator, you can very quickly kind of scan it over and it works very smoothly and it's well integrated with one another. I think you guys are starting to get the idea here. Long story short, net everything for most people, as long as you're not like literally like a YouTuber like me who, I don't need to work with anybody else or whatever the case is. If you are a small business, you probably need to go through Adobe. It is probably on a total cost of ownership basis, it is the lowest total cost of ownership with employee expenses, time expenses in terms of, having to figure this stuff out. The total cost of a software itself, you get the bundle of apps compared to if you wanted just point solutions for everything, it would cost a lot more. All in all, you guys get the point. Adobe is king. There's a reason it has a 60% revenue market share and 90% of professionals around the world use it. So that's on the competition side of things. Again, this doesn't mean in the future, and I do anticipate there will be another Figma that does something way better. Will it materially impact Adobe? No, because that wasn't Adobe's profit generator to begin with. Adobe's profit generator is the fact that whoever is using Adobe, the professionals, the 90% professionals, they need the entire thing and they need to collaborate with other people. So if there's a point solution that comes up that does one thing really, really well, that's not enough. So using the aforementioned first principles style of thinking, this is something that I wrote in the Discord. It's pinned, by the way. And if you do have access to the Discord, I do highly recommend you go through and you read this entire thing. I pinned some very useful piece of information that I've kind of collected over time. But anyways, using the first principles line of thinking, if we wanted to compete with Adobe today, this is what we would have to essentially accomplish, right? So item number 1, we need the tech to be better. But even if the tech was better, why would you switch when Adobe gets the job done and is good enough? Odds are you're already paying for Adobe and there's actual material switching costs of you saving all your information within Adobe for the past decade. All your data's there, you know how to use it. There's literal time switching costs of moving away, right? Item number 2, even if the tech was better and it was cheaper, it's probably not better and cheaper across all of the Creative Cloud. There's another point. Sure, maybe you make a Photoshop competitor that's better and cheaper, but odds are you don't have a competitor for all 60 apps or all 20 Creative Cloud apps. Okay, point number 3. But by some miracle, right? We get it. It's better, it's cheaper, and it's for every single Adobe Creative Cloud software, which is just ridiculous. I don't think there's ever going to be a straight up Adobe competitor of that scale, unless it's like big tech trying to enter. But again, why would big tech dump billions into it? We covered this in the last video. It's not going to happen. So by point 3, this is we're in the land of impossibility to try to compete with Adobe. There are switching costs involved with migrating even the work of 5 employees over to a new software. Never mind any Fortune 1000 company who has been an Adobe customer for decades, not to mention Adobe Creative Cloud is closely integrated with the Experience Cloud, which is kind of like a CRM software, but for marketing, which is used for, like analytics, managing social media campaigns, A/B testing. So particularly for enterprise, they're also an Adobe Experience Cloud customer. So there's even more switching costs on that side. But yeah, there's time learning switching costs. You literally have your data stored inside of Adobe switching costs. And depending on when you're actually canceling your membership, there's switching costs of literally paying to cancel the membership, which is a bit, a dirty of a business practice. But nonetheless, this is something that Adobe does. And it's another barrier for you to move away from Adobe. I do agree, it is a dirty business practice, but nonetheless, it's there. And so here, we're in the lands of impossible squared, even by some miracle. If there was no data migration costs at all. Okay, sorry, this kind of ties into my last point. There's relearning costs of your employees that need to relearn this new software across the entire organization, and that will cause quarters or years of lost productivity. Item number 5, even if by some effing miracle, all of those issues were solved, no entity can ever guarantee everything will go smoothly. They can promise this is all true, but in the back of the mind of every single executive, they're thinking, what if 10% chance something goes wrong? Hey, James, how much of our marketing budget is spent on Adobe software? Oh, we spend 2% of our annual budget on Adobe software. So even if you solve all of those questions, you're ultimately competing. And we just saw this in an example with Linus Tech Tip. Even for him, the cost was such a small portion of his entire business's costs. So even if all of those issues are solved, there's no way you can actually guarantee this migration will go completely smoothly. And these businesses are making this switch for a very irrelevant sort of saving in terms of costs. For a big company like Pepsi or something like that, we don't have the numbers on this, but it is in the low single-digit percentage of their total marketing budget. The majority of their marketing budget, I would say half of their marketing budget, is spent on ad placements. It's spent on literally paying Google, Meta, TV, radio, whatever, for that ad placement. So it's an irrelevant cost. I believe Alonzo, again from the Discord, he called it paper clips, meaning it's like you're trying to save on paper clips, meaning it's such a small little, he's calling Adobe paper clips in terms of being an insignificant spend. But of course, this is specific to that company, right? Like it's such a small portion of the spend. It's something mission critical. Why are we even looking to cut down cost in this segment of the business? So the shortest conversation in software that you could have is, hey, we're going to go try to disrupt Adobe. Shortest conversation. They just laugh you out of the room because of those 5 reasons. You're not going to. Even if by some miracle you beat Adobe in every way imaginable, nobody will still want to switch because the cost to maybe this goes wrong really badly is just not worth it. Not to mention, okay, we switch one customer over. There's network effects across the entire industry. Now everybody in that company can't really collaborate with people in other companies that use a different software. So it's just stupid. It just doesn't work. It's not going to happen. The moat of this company is seriously impressive. It's right up there alongside other big tech companies. If the stock wasn't down so much and sentiment wasn't so bad, people would start to acknowledge how wide moat this company actually is. So in terms of competition, it's basically irrelevant is my takeaway from everything that I've studied around Adobe. There's so much more that I could show you in this video, but we really don't need to spend that much time on it. The numbers speak for itself. Competition is not new. Canva is not new. Canva's been around for 15 years. They have not even started to leave a dent in Adobe's moat. Adobe is a professional software. Professionals, they don't even get to choose, but the bosses of the professionals will choose Adobe for them, and they have to use it because it's the industry standard, because there's network effects, because there's switching costs in terms of relearning new software. You guys get the idea. We'll just move on here. The more realistic problem, which is a bit ambiguous, which is a bit unknown and we don't know at the moment, is will AI be seat dilutive? If your average employee is twice as efficient, does that mean we need half as many employees? And we could go back and forth with the numbers and debate it. I'm personally of the belief that if your average employee is twice as efficient, maybe you don't need as many employees, but that doesn't mean you have to cut all 50% of them. Nonetheless, it probably still means that you don't need as many employees, right? In one way or another, this is a bigger risk to Adobe because how does Adobe make money? They charge $100 per employee. To combat that, the geniuses at Adobe have started something new. And so this is something that was directly asked very clearly in the Adobe Max conference call or in the Q&A. And so here's what the CEO had to say, right? So the Doug Clark, the analyst, he asks, one of the fears over time has been whether generative AI could be dilutive to seats. We've talked about it for probably 3 maxes now. The counterpoint to that has always been that demand for content will explode and that will only offset the seat productivity and hopefully your customers will get. I'm curious, as we're sort of on the 2nd and 3rd max of talking about the topic, even anecdotally, how is this all playing out? Is the seat dilution happening? Blah, blah, blah. And so David starts off by saying, content explosion is definitely happening. It continues to be growing at a disproportionate rate, especially as people are consuming different types of content. What we're seeing is continued growth in terms of seats with Creative Cloud. When you look at Express MAU, I think, when you look at Firefly growth and Firefly MAUs, we're growing more users and coming into the franchise, and we're seeing that increase happening. We're also seeing growth in automation. We talked a little bit about this in terms of some of the guidance for Firefly services and Firefly creative production. And we're seeing both seat growth increasingly, also new customers coming into the low end and the freemium side of the business. Anyways, they talk about some more unrelated stuff, but then eventually we get down here. And Dan, I absolutely love Dan out of all the different executives. I think he's kind of like the biggest straight shooter when it comes down to the exec suite. And so he mentions, we talked about the consumption-based economy alongside the subscription-based economy. The reason for doing that was as we bring more people deeply into the products enabled by these capabilities, it allows us to better align economics with the deep value that they're driving from those products. Basically, what he's saying is, if we have now created a version of the product and the software where the amount of money that we charge you as Adobe is directly tied to the productivity that you gain. So if you are now using generative AI products and you have now become twice as productive, we are tying that to AI credits. They're charging you AI credits for using all those different AI features. And so if you've now become twice as productive, you're now technically in a way paying twice as much to Adobe using the AI credits because you're paying for a base subscription. And then on top of that, you're paying for AI credits to unlock that productivity. So even if we start to lose some of those subscriptions, the management believes that will be more than offset by the amount of money that they'll be making with AI credits. And so this is very important because earlier in the question, they asked about, you guys believe that, content explosion will more than offset for seat dilution. So they said, we don't see any signs of seat dilution yet, but we are absolutely seeing signs of content explosion. People are generating content at higher and higher rates. And we only see this trend going up over time. And so I mentioned in the first video, I don't know if you guys recall, but I mentioned in the first video how this is a more strategic alliance for Google than it is Adobe. This benefits Google a lot more, and Adobe is doing the favor to Google because with the world of content explosion, a sort of moat that Google can build around YouTube and particularly YouTube Shorts, because they've kind of fallen behind. They're the 3rd place behind TikTok and then Instagram Reels, and then it's YouTube Shorts. A mini moat that they can start to build now over time is allowing the creators of YouTube Shorts to be able to edit their videos better than the creators of TikTok and the creators of Instagram Reels. And so they've done that they very recently announced this. I mean, at the time of this recording, this was literally announced like 12, 13 days ago, but they announced that they're going to be partnering up and integrating Photoshop for YouTube Shorts. Oh, I'm not showing my screen. As you can see, they're going to be, Adobe and YouTube are partnering up for YouTube Shorts, and Adobe is essentially creating these mobile apps because they can, farm extra revenue from that, but more importantly, to integrate it well with YouTube Shorts and that type of stuff. So this is a strategic alliance where Google gives you the model, and then you do us a favor back, and you make our YouTube product easier to kind of create content that's so-called content explosion and so on and so forth. And so going all the way back, the company has already thought of this, the seat dilution issue. If it happens, they have now pivoted the business to a consumption model and they'll be able to benefit from that over time. If it doesn't happen, also not a problem. The traditional business works fine. And, any incremental revenues gained from reselling generative AI credits, then that's amazing. And then to tack on another point, because Adobe is a massive company, they can kind of, this reminds me of Shopify in a little bit, they can kind of bargain on your behalf to get a very attractive per credit cost of those credits from Gemini or whatever, and they kind of bargain on your behalf to make it cheaper for you to use these AI credits. And then on top of that, for if they have like guarantees of like, oh, Disney, you're going to use like trillion credits or whatever the case is, they can give you a lower rate per credit because they have like a guarantee from Disney that you're going to be using. They kind of give you like bulk discounts and stuff like that on behalf of Gemini. So it's very cool. It's a very attractive model because they didn't have to dump 100 billion into CapEx to make the model. More importantly, their core business doesn't get disrupted. More importantly, even if their core business starts to kind of fade away with the seat dilution issue, they actually end up being a net benefit or net everything. They end up benefiting even more because you'll probably see a revenue reacceleration as a result of charging for AI credits. I mean, either way, I think you end up seeing revenue reacceleration for charging for as a result of charging for AI credits. I do recommend, again, similar to the Max, listen to the Max Q&A particularly. The first half is spent kind of doing just like general talking about all the different things. The second half, when they get to the Q&A, that's the good stuff there. I do recommend you listen to that. Anyways, I think we are now finally at the end of this saga. I believe I've covered everything. I covered why AI net everything will be a benefit to Adobe. I talked about how the competition is effectively irrelevant. I talked about how even if, they integrate, or once they integrate it, I mean, they already have integrated AI. So now that they've integrated AI, if there is seat dilution that is going to happen over the next couple of years, that is also kind of irrelevant to Adobe because they can charge on a consumption basis. And if they charge on a consumption basis, that's probably going to reaccelerate revenues, if anything. Now we stand at a very interesting point. The fundamentals, the valuation, the projections into the future, if you will. Currently, and I'll show you this to you on Fiscal AI, Adobe is growing their revenues, I believe, at about 11%. They've been able to grow at about 11% for quite some time now. As you can see, since kind of like, late 2022, 2023, they've kind of grown at that 11% pace for a while. Margins with this company doesn't really expand that much. But they are doing a lot of buybacks. And so as a result of that, actually, if you look at it on a per share basis, your revenue is like growing at about 16%. And, you throw in any amount of margin expansion, that means free cash flow per share growth of roughly 15, 16, maybe 17%. On a going forward basis. I think they can reasonably keep this level of growth. They've been able to do it for the past 3-4 years. The math on that, by the way, we're saying roughly about 4% revenue growth from just price increases on average across the board. This is what they've averaged over the long term. You have another about 4% increase in terms of, if you have Pepsi or your average customer today, they either trade up in terms of softwares for certain different employees, or they hire more employees altogether. That's, again, about like another 3-4% there. And then another 2-3% of revenue growth comes from acquiring new customers or expanding into white space in more countries, because that's still a secular growth trend for them as well, right? So roughly 10-11% revenue growth just as a base level. I don't think it goes much lower. I have it at 10%, right? And again, this doesn't include projections of the consumption model being able to increase their revenues, but anyways, we'll do a different projection for that later. So we have a 5% buyback. That's what they're currently doing. 10% revenue growth. That's also what they're currently doing. And I think that's literally the floor. And 37% operating margins. That's what they're at right now. These are, in my opinion, very base level, super conservative assumptions for the next 3 years. If Adobe is valued at the same 16 times price to EBIT or price to operating income that it is at currently, you end up with a 17% stock return. You can do this with free cash flows, by the way. It is the exact same thing. You'll get basically the same number. Adobe can go down to 14 times earnings and they will still get roughly an 11% return. Adobe can go down to 13 times earnings and you'll still end up with a 9% return. Now let's change these numbers around a little bit, right? Let's say we do 4% revenue growth. This means they get 0 new customers. The customers they have, they don't grow in terms of license count. They just maintain the same number of users they have now. And the only method of growth for this company over the next 3 years will be price increases, okay? 4%. Margins. In this scenario, let's be a little bit more fair. Margins will end up expanding. So let's do 39% operating margins. What do we end up with? At the same valuation, you still get a double-digit return. Are you starting to see the level of bearish sentiment that is incorporated into the stock price? Even if we don't expand the margins, you still get a market-beating return of 10%, 11% almost per year. Now, what happens if the multiple goes up? If the multiple goes up to roughly 23 times earnings, that's a 23% stock return. And if we take a look at the EV to EBIT multiple over the past little while, you can see they've averaged a 40 times EV to EBIT multiple. Now, I'm not expecting for that to go back to 40, but from the 16 that it is at today, do we realistically expect that maybe it can go back up to just 22, 23 times? That wasn't that long ago. That was literally the bottom. It was like a 21, 22, 23 times EV to EBIT multiple in late 2022. So the company is stupidly cheap. It is dirt cheap. I think at a minimum, it probably goes back to 20 times EV to EBIT. But even if it doesn't, you still end up with a 11% stock return. Now, this is super bearish, like disaster scenario that they only grow through price increase. Margins don't expand and you end up with that buyback. In this scenario, I would assume they actually ramp up the buybacks, but I'm not going to price that in. In my opinion, the more realistic, probably close to reality over the next 3 year scenario is buybacks actually goes down, because I assume the valuation will go back up in a little bit here. Instead of the 11% or 10% revenue growth, we end up with a little bit more. I'm going to say 12.5, right? Slightly faster. And then margins, I'm going to bump the margins up to just 39%. In reality, you could probably even fetch a little bit more. And instead of the 17 times EV to EBIT multiple, I think the company can land somewhere in between here. I think between, like a mid to high, probably like a mid 20s sort of EV to EBIT. Something like this, something like 25 times EV to EBIT. It is a $840 stock price by the year 2028. That is a 37% annual return over the next. This is probably a realistic scenario by my estimates. A more bullish scenario, if you guys would like to see, I would say probably revenue reaccelerates to 13.5 or thereabouts. Margins go to 40, and then you see the multiple expand all the way back up to 30 times earnings. That's a 50% per year CAGR. I don't think this necessarily happens. I think Adobe is permanently going to be valued a little bit lower, around 25 times EV to EBIT. But there's a very real possibility the revenue does reaccelerate to 13% and beyond. It's very possible. And the operating margins of 40%, I believe they've actually achieved them before. Okay, it seems not. But anyways, this company has inherent operating leverage built into the business, and it's very possible for them to achieve a couple percent more in terms of operating margins, right? And this doesn't swing our predictions too much, right? Give or take, couple percent up or down. The point is, the stock is stupidly undervalued. No matter what you really do with the assumptions, even if we go the most stupid disaster scenario, the company grows at 4% revenues, you still end up outperforming the market over the next 3 years. If you do a moderate scenario, you end up doing like 20-25% CAGR. If we do a slightly more bullish, in my opinion, realistic scenario of a little bit faster revenue growth with a significantly higher multiple, you're looking at 30-40% CAGR. This is close to $1,000 stock, maybe like a $900 stock by the year 2020. As always, not financial advice. I will never outright tell you to buy or sell a stock. I hope this served as a good starter for your due diligence of Adobe. Go listen to the Max Q&A, go listen to the Max conference call, go listen to all of that, decide for yourself, learn a little bit more about the company, and most importantly, if you have one takeaway out of this entire hour and a half video, whatever the case, use a first principles line of thinking, decide for yourself, ask yourself, what would it take for XYZ threat to disrupt Adobe? As it stands currently, for the record, I have trimmed most of my Google. Nothing against Google, just high valuation. That's the only issue. I did a video on that if you want to watch it. I trimmed most of my Google and I put all 20% of it into Adobe. I think without a shadow of a doubt, Adobe will be outperforming Google over the next 3 years, and it will outperform it massively. I'm looking to possibly make this my biggest position. If I had the cash, it would be a 30% position today. Frankly, I'm willing to go as high as 40%. And there you have it, ladies and gentlemen. Adobe is the most dislocated, the most undervalued, the most misunderstood company in all of my time investing. Thank you very much for watching, and I'm looking forward to seeing how this video ages in 3 years or 4 years time. My suspicion is it will end very well. Actually, to throw a very egregious statement all the way at the end of the video, I told my mom, I said, Mom, I'm so confident in this call, I would be willing to bet this entire house that we're living in. I'd be willing to bet the house on it. She kind of laughed it off. I'm being serious. I assign personally, and again, don't let this cloud your judgment. Don't let my bullishment, don't borrow the sentiment from me. Don't borrow your bullish sentiment from me. Go decide for yourself. After hundreds of hours of research, with everything I know at the moment, I am 100% confident that there's a 0% chance of disruption risk to Adobe. And all it takes is that little stock price moving up a little bit, and all of a sudden the bullish sentiment flows back into Adobe. Thank you very much for watching, and have a great day.